The financial information provided is not to be used for investing purposes. If you do wish to use any of the news or information provided, please seek a certified financial advisor or certified financial professional. John Galt, the host, JohnGaltFLA.com, nor TheWatchman.biz cannot be held responsible for investing decisions the individual or listener makes using the free information provided.
Good Monday morning. Normally I would have had this video up on Sunday night, but it was Easter Sunday. It was time to spend some time with the family and reflect on everything. It was sort of nice to have everybody over. I hope everybody had a great Easter, enjoyed the holiday weekend. I know I did. The news this weekend is astonishing. The Middle East news has been exploding everywhere. The overnight news has been the rise in the precious metals and oil, decline in the dollar. So stay tuned to JohnGaltFLA.com for cutting-edge commentary. And don't miss the radio program on Monday through Friday from 7 to 9 p.m. Eastern Time, only on TheWatchman.fm. Without further ado, let's hop into what I call the big news, which is the lack of participation in the financial sector. Starting with the big bad boy, J.P. Morgan, founder of the Federal Reserve. Here's a 6-month chart telling you it's trading below the 50-day moving average. The big problem with that is that's the danger zone, as I've circled there. This prolonged trading period below the 50-day previously was offset by earnings reports. This time it hasn't been. In fact, it continued to decline due to the earning report. And when you look at the 3-year chart, you see that it's relatively flat. Oh, it bounced off the lows from 2008, but it hasn't made any type of new high nor cracked the resistance up above $50 per share. The fail-safe zone is right there between $29 to $34 per share. I think it's not going to hold, but that is what they'll call fail-safe. Once it breaks down below that area where the first major golden cross occurred, it has the potential to retest its all-time lows or get down to close to $20 per share. Next up is Goldman Sachs, which has an even worse trading pattern. This is a 6-month chart. As you can see, it's below the 200 and the 50-day moving average and has been for a prolonged period of time. It's a very bad move because you had a major sell-off with volume. Bad mojo. Usually that technical indication is this stock is poised to break down even further. The question being, where can Goldman Sachs break down to? For that answer, you have to go back to a long-term chart. Now, I'm only using a 3-year chart. I could use a 10-year chart just as easily. But when you look at this 3-year chart coming up on your screen, you see that it has a similar chart pattern to J.P. Morgan and many of the other major financial institutions. It's flatlined. It couldn't even get close to its all-time highs of 200. Couldn't even break 180 in this last move. And we've got its fail-safe zone down between $100 and $110 per share. I don't think that's going to hold either. I think we're going to retest somewhere between $75 and $80 per share as its intermediate to long-term play. There's a massive crush coming in the financial sector, the failure of the financial sector to rally to new highs while the rest of the market is usually an anchor ready to drag it down. So you look at some of the other big stocks like Citigroup. Citigroup has a very similar trading pattern. Everything below the 50-day moving average, it's declining. It's going to have a death cross soon, probably before the reverse stock split in June. The reverse stock split's not going to do anything to accomplish, anything but get rid of the technical trading pattern because it's a day trader's paradise when you play Citigroup. That's why the volume's so high. If you look at the 3-year chart of it, you see it did not recover back to its all-time highs like the other financials, and it's pretty much flatlined between $4 and $5 per share. When it goes, it's going to cross, even if the revenue with the reverse stock split, don't get excited. Here's a more disconcerting chart. Bank of America, 6-month chart. Look at the deterioration since February of this year. We had a nice beginning of the year rally, tried to get it back up into some reasonable high territory, failed after a golden cross, rolling over towards a death cross, and now trading well below the 200-day moving average like Goldman Sachs. If you notice the downtrending line on the 50-day moving average that I pointed out with the arrow, and the portion of trading below the 200-day moving average with increasing volume is a very bad trend. I think we'll see a death cross here in May. May will be the capitulation point for most of the major financials and a lot of the regionals. More on that later. But it does indicate that Bank of America's prolonged weakness is continuing. The long-term chart of Bank of America is also showing a massive failure, much like Citigroup, never recovered its all-time highs up above $30 a share. Didn't even make it above $20 per share, which you're going to see where I drew a trend line to sort of reflect, hey, we couldn't even get above that level. That means that this thing is poised for another massive down leg. And when I say a massive down leg, I mean Bank of America is due to correct after the death cross, probably will roll over and retest that region down around I'd say 4 to 550, 4 to 575 per share. The downtrend is pretty much confirmed in the stock. They're not generating revenues. They have that stupid countrywide purchase. They've got liabilities with Merrill, and they've got Golden West. They managed to sit there and stick their nose into everything as far as the financial sector is concerned. And what did they buy? Residential housing and mortgages. It's going to come back to bite them. This stock is a $4 stock. It has it written all over it. Take my word for it. It is very, very ugly. Morgan Stanley in similar shape. Bad trading pattern since the 1st of March, below the 50-day moving average. Now trading below the 200-day moving average. The 50-day moving average has rolled over. As you see here where I've circled it, continue trading there, and that blue line is descending towards the red line. That's the 50-day heading towards the 200. We're going to see a death cross in that particular stock also in May, and it's going to break also. It has the exact same pattern as Citigroup and Bank of America on a 3-year chart. Failed to make new highs, failed to break out, failed to get any more volume gathering on the upside momentum. This stock is poised to go back and retest its level. I have a target price on it between $12 and $14 per share over the long term. Once it breaks down this time, I think we break those support levels around 22, and we're going downtown and going downtown fast. This is a very bad development for this stock because it means that they really don't have a clue as to what it's going to do over the long term. And it also tells you that investment banking may well be dead in the United States of America. Wells Fargo is not in good shape either. Again, prolonged trading, high volume, below the 200-day moving average on extremely high volume. Then you look at what's been going on since probably the end of February, 1st of March, trading below the 200-day moving average. Once again, another major financial victim of the housing crisis, not getting any stronger, and in fact poised to break down even further. When you look at it on this long thing here with the sell-off on high volume, it's a very bad sign for the future. The stock does not have any velocity to the upsides. It's broken down completely this year. Investors know that the financial sector is dead, and without the financial sector, the entire market will break down. If you look at the 3-year chart of Wells Fargo, you'll begin to understand what I'm talking about. Very similar pattern to JP Morgan, but less healthy. Also an ugly pattern chart like Goldman Sachs, more akin to it. When you look at what's happening with the acquisition of Wachovia, I say this thing is a $10 to $12 target price. It's going to break down on further deterioration in the residential real estate market. There will be more problems as far as lawsuits, liquidations, and foreclosures, causing all of the commercial banks who are heavily engaged in the real estate sector to sit there and see declining revenues. Maybe not earnings because they're still able to game the system, but declining revenues, which eventually comes home to roost. The XLF is also reflecting the same problem. Let's look at the broader index with the XLF, which includes the insurers. The reason it was able to make this nice move for the last 6 months is a lot of the insurers were not reflecting any problems, but they're also starting to see some issues arise because people who had insurance aren't renewing their insurance because they don't have their homes anymore, along with many other subject matter to that extent. Unemployed people don't buy insurance. They also don't invest. They also don't get into the bank or stock market. And people are panic stricken about the condition of the stock market. Look at the trading period below the 50-day moving average. The 50-day moving average is also rolling over down towards the 200. It will take longer for the XLF, but over the 3-year chart pattern, I see this coming back to $8 to $9 to test that low area from early 2009, late 2008. And I've highlighted it there in the chart. I think the XLF is destined, and we're going to start seeing some of the major insurers fail in this country also, along with a couple of more bank failures and massive consolidation. The Philly Regional Banking Index, the KBW, is also telling us the same thing. It's been bouncing up and down, but couldn't get above the 5607 mark. That is a little bit disturbing because it should have been able to hold the line there and crack above that. Instead, That 5607 has turned out to become an epic fail. Couldn't reach it twice in the last 6 months. It is starting to roll over. The regional banks are starting to report more losses from real estate. Once again, the KBW is simply complementing what the large banks are telling us and also warning you that this entire system is unstable. This the 6-month chart also is showing a short-term target that I've highlighted just between 49, I would say about 49.70, 49.80, where the golden cross occurred back at the start of this year. I think we're going to head for that in the short term, and a lot of regional banks are going to start failing if they can get the budget mess straightened out in Washington, D.C. The 3-year chart is also quite ugly, not like the other financials and the major financials and investment banksters. When you look at this chart, you look at it and you think, well, that's been a very choppy trading pattern, but there's one persistent theme. Ever since the peak in 2008, it's been in a long-term downtrend. Lower highs, new highs, lower lows until 2000. They reliquefied the market in 09 and 10. Now it looks like we're poised to go back and retest the lower lows portion of the theory. And I think over the long term, the target area for this is a retest of the 3-year lows. The downtrend is confirmed. You have a long-term downtrend. You have epic failures. Every time it gets close to a new high, it couldn't break 5607. Odds are the entire index will break down and retest the 29 level. Folks, this is a bad indication. To hear more on a nightly basis, tune into the Voice of Galt only at www.thewatchman.fm. I'm on Monday through Friday from 7 to 9 p.m. Eastern. You don't want to miss the programs this week, as we have Ben Bernanke giving his first speech, which I'll have extensive commentary about, after an FOMC meeting as part of their new policy. And also, we'll be discussing the silver bull market, which is raging wildly. I think that is truly an indicator that we're nearing some major short-term tops. I'll try and get the next update up Sunday evening. I don't think I'm going to have a problem this week, as my travel schedule is now somewhat restrained. I'll be working more locally. For John Galt and the Voice of Galt, folks, stay tuned and stay safe. The markets have gone insane.